This is the fifth and final video in our journey to complete a master budget for a merchandiser. In this video, we will be completing the budgeted balance sheet and praying that it balances. You will typically be creating your budgeted balance sheet based on the original balance sheet you were given in the problem. Here on the right, you see the balance sheet as of December 31st, 2020, the end of the previous year. On the left is the template for the budgeted balance sheet we will be creating. Notice that all of the accounts are exactly the same as the beginning balance sheet with the exception of the notes payable, which I have added because of the bank loan that we took out relating to the cash budget. We start with assets. The first asset is cash, which we can find on the cash budget. Remember, we need the ending balance for March, which we can see here is $30,000. Next, we need to calculate the accounts receivable balance based on the sales budget and the schedule of cash receipts from sales. At the top of your screen, I have the sales totals from the sales budget. Looking at the schedule of cash receipts, you can see that I've added a total column, where I have simply added up the totals for the rows. So now we know that $2,500 was collected from the November sale, $12,000 was collected from the December sale, etc. We want to know how much of each total has not been collected. Whatever still needs to be collected as of the end of March must be a part of the ending accounts receivable balance. First, looking at the beginning balance sheet from December 31st, 2020, we see that there was a $14,500 accounts receivable balance. If we add up the total collections from sales made in November and December, we get $2,500 plus $12,000 equals $14,500, which is the beginning accounts receivable balance. This tells us that the entire beginning accounts receivable balance has been collected. So there is $0 that still needs to be collected from November and December. For January, there was a total of $33,000 in sales. We also see that the entire $33,000 has been collected, which leaves us with $0 uncollected, calculated by taking the $33,000 in sales minus the $33,000 that has already been collected. The February sales are $38,500. Based on the schedule of cash receipts, $34,650 of those sales have already been collected. This suggests that the difference, $3,850, still needs to be collected and is therefore a part of the ending accounts receivable balance. The March sales are $44,000. We see from the schedule of cash receipts that $26,400 have already been received from the March sale. Therefore, there is still $17,600 to be collected in accounts receivable, the difference between those two numbers. Adding up the sales that still need to be collected from February and March, we get $3,850 plus $17,600, which equals $21,450, which is our accounts receivable balance on the budgeted balance sheet. So returning to our balance sheet, we can put $21,450 as our balance for accounts receivable. Next, the inventory. For this, we look at the number of units budgeted for ending inventory from the merchandise purchases budget, which is 720, and we multiply by the cost of merchandise per unit, which is $35. This gives us $25,200. Next, we have the office furniture. There were no purchases or sales of office furniture, so we can copy down the same balance we had as the beginning balance sheet, which is $36,000. There was an additional $1,500 of depreciation expense, which we can see from the general and administrative expense budget, so this gets added to the accumulated depreciation balance that we already had. $5,000 plus $1,500 equals $6,500. We can subtract the accumulated depreciation from the office furniture balance to get the book value of $29,500. Next, we can add up all of the assets to get the total assets, which come to $106,150. Now we can move on to the liabilities. First, the accounts payable, which for this company is only related to merchandise purchases. We need to look to the merchandise purchases budget as well as the schedule of cash payments for merchandise to determine the accounts payable balance. At the top of the screen, I have the end result from the purchases budget, and below I have the schedule of cash payments for merchandise. We use a similar process to what we used when we found the accounts receivable balance. Remember that all merchandise purchases are paid for within 1 month of the sale, so theoretically we should only have an accounts payable balance from March purchases, but we will verify that here. Again, we have the total column, but this time it is for the total payments for each month. Adding up the rows, I calculated the total payments for December to be $800, January are $19,600, etc. We want to know the unpaid portion of each purchase. You may remember that the $800 payment relates to the beginning accounts payable balance from the December purchases, so there isn't anything left to pay. This transaction cleared out the beginning accounts payable balance. We see that the January and February payments match the purchase amount. The total amount purchased has been paid, so there is $0 unpaid for each of those 2 months. Looking to March, there was $30,800 of merchandise purchases, and only $24,640 was paid. This leaves us with $6,160 that still need to be paid from March, which becomes our accounts payable balance. If we had an unpaid balance from the other month purchases, we would have to add them together to get the accounts payable balance. Returning to the balance sheet, we can fill in the $6,160 accounts payable balance that we just calculated. Next, we have the income taxes payable. Remember that the income taxes from the last period were paid in February on the cash budget, so the only income taxes that still need to be paid are from the current period. We can see from the budgeted income statement that the income taxes are $3,775, which becomes our income taxes payable. We now have notes payable because the company took out a bank loan to meet their cash requirement. On the cash budget, we can see that the bank loan is for $1,053, so that becomes our notes payable balance. We can add up our 3 liabilities to get a total of $10,988. Next, we can move on to the stockholders' equity. The common stock didn't change at all throughout the period, so it still has the same $38,500 balance that it had on the beginning balance sheet. The retained earnings balance is equal to the retained earnings balance from the beginning balance sheet, which is $55,000, plus the net income of $5,662 minus the dividends from the cash budget of $4,000, which gives us $56,662. The total equity is equal to the common stock balance of $38,500 plus the retained earnings balance of $56,662, which equals $95,162. The total liabilities and equity are equal to $10,988 plus $95,162, which equals $106,150, the same balance as the total assets. Alright, that completes our budgeted balance sheet and the final budget in our master budget.